Welcome. Today is Friday, December 15th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners and the founder of Alpha Insights, and this is your Daily 5. Today we're going to talk about 5 charts that I think are pretty important going into year-end and particularly into 2024. But before we get started, I really just want to remind everybody that we do publish a monthly investment newsletter that's available on Substack. It is affectionately titled Huge Insights, The Big Picture. We are about to publish our 28th issue. That is due out on January 6th, and it will be our 2024 market forecast issue, probably the most important piece we will have written to date. It's free to subscribe, and it's delivered directly to your email inbox on the first Saturday of every month. So that'll be January 6th at the next publication. The publication really focuses on key macro factors affecting the economy and the markets. We do get a lot of inquiries from people after they read the introduction to the newsletter. Hey, tell us more. We want to know how to take these ideas and really incorporate them into our investment strategy. And so, for those who want more, we do have an option to upgrade to paid for as little as $12.50 a month. And that includes our monthly market forecast and positioning recommendations, in addition to a number of perks that we think are pretty valuable. In fact, paid subscribers also receive our weekly Alpha Insights Idea Generator Lab publication. This is an institutional publication that comes out every Wednesday and details our top actionable trade idea and also provides some additional updated market commentary. Again, that's every Wednesday afternoon. And in addition to that, we do offer some privileged members only sort of video content, as well as access to periodic interim bulletin reports that we put out typically just to our institutional investors. So it's quite an upgrade. If you do decide to upgrade to paid, I think there's a lot of value there for the price that we charge. With that said, let's just jump right into chart number 1. We wanted to review investor sentiment, especially since sentiment is now nearing a bullish extreme again. Here we're looking at the Fear and Greed Index. This is a compilation of 7 different indicators, all of which measure some aspect of stock market behavior. The indicators themselves include market momentum, stock price strength, stock price breadth, the put-call option ratio, junk bond demand, market volatility, and safe haven demand. And so this index really tracks how much each of these individual indicators deviate from their averages compared to how much they normally diverge. And it's measured within a range of 0 to 100. And so when we aggregate all 7 of those together, we come up with this index, and it's published by CNN. Anybody can access it. But the way the index works is when it gets above 75, it basically represents maximum greed. And you can see back here in kind of the July-August period, we reached that sort of maximum greediness. And what happened after that, the market tanked by about 11% or so. When it got down here below 25% in late October, early November, that was indicative of maximum fear, and it represented a great buying opportunity. And so, the real issue here is that we've now seen this index rally back up to this level that is, kind of indicative of maximum fear. In fact, we tagged the lower boundary of that range at around 75 the other day and have pulled back somewhat in the last 24 hours. But really over the last 6 weeks, we've really seen a marked reversal in investor sentiment from levels of extreme fear back in October to levels approaching extreme greed today. And that should kind of tell us what neighborhood we're in. We're in a neighborhood where prices are probably very close to a high and poised to reverse, at least to some extent, if not a corrective pullback, possibly something more important. And we'll talk about that in a second. Chart number 2. We are looking at a Dow Theory Non-Confirmation. What's Dow Theory? Dow Theory is an approach to the market, market analysis. This was developed by Charles H. Dow. He was the founder of the Dow Jones Company, which publishes the Wall Street Journal, and he was also the developer of the Dow Jones Industrial Average and the other averages, the utilities and the transportations, dating back to 1896. Now, Charles Dow believed that the stock market as a whole was a pretty reliable barometer of overall business conditions within the economy, and that by simply analyzing the overall market, one could accurately gauge those conditions and identify the future direction of stock prices. And you know what? That's the basis of technical analysis, and that's the long and short of it. For a trend to be established, Dow actually postulated that the indices or the market averages need to confirm one another. And this means that the signals that occur on one of the major indexes must also be matched or correspond with the signals that are being generated by the other major indexes. And if they don't, then Dow suggested that the market may be sending a false signal. So in short, when we see something like the Dow Jones Industrial Average climb to a new all-time high, which we saw occur in the last couple of trading sessions, then we need to see the Dow Jones Transportation also climb to a new high in order to confirm that uptrend. And unfortunately, what we're seeing right now is the Dow Jones is taken out, or the industrials have taken out their prior highs achieved back in January of 2022, yet the transportations are trading at a fairly deep discount to that prior high. And so this leaves in place a negative divergence or a non-confirmation, as Charles Dow would have referred to it. So at this point, the new high in the Dow Jones Industrial Average is unconfirmed by the transportation averages, and that leaves a question mark in mind. Now, if we take this one step further and we take a look at a broader representation of the stock market, not just those 30 price-weighted stocks in the Dow Jones Industrial Average making a new high as we see here, but we could also look at the NASDAQ 100. Another narrow market with, certainly the best of the best, right? The leadership of this rally has largely been concentrated in, the top 7 stocks, now known as the Magnificent Seven. They tend to dominate the NASDAQ 100, about 60% of its market cap. And yet, unfortunately, we have not seen a new closing high from the NASDAQ 100. And we're getting very, very close. Don't get me wrong. And it could very well happen today. But so far, this new high in the Dow is unconfirmed by any other major average, including the NASDAQ, the S&P 500, which is still a couple percent below. If we look at the NASDAQ composite, the broader version of the NASDAQ, down some, 7% or so from its high. The NYSE still down around 4 or 5% from its high. The Value Line Composite down some 15% from its all-time high. If we look at the equal weight S&P 500, it's still trading around 5% below its high. The Russell 2000, a much broader secondary index, down some 15% from its high. And the Wilshire 4500, this is the extended market index, everything except the S&P 500, is some 17, 18% below its all-time high. So, as we get further away from these high mega cap concentrated leaders, the market really hasn't experienced the same sort of performance across the board. So it leaves the question mark in mind, and widely, this is widely believed to be a bearish non-confirmation. These intermarket non-confirmations are not a bullish condition. They are a bearish condition at worst, and at best, they leave an open question mark. Chart number 4. This is a chart we've talked about in several recent presentations. It's the moving balance indicator, the MBI, and the MBI has still yet to show us a breadth thrust for this move off the October 27th low. And our view is that this leaves, again, an open question in mind. Should we trust this breakout in the Dow Jones Industrials? Because we're just not seeing the sort of follow through that we would if we were in a new bull market. And why do I say that? Well, you know, the moving balance indicator really is the most reliable breadth thrust indicator that we've studied, certainly. And you know, the way that it works, and without getting too deep into the weeds here, the MBI really just measures the momentum of the 10-day moving average of net advancing issues on the NYSE. And when the MBI gets above 85%, it's indicative of a very powerful surge in the market's breadth. It tends to mark the beginning of a durable advance in the stock market, in the S&P 500. And if we look at the S&P specifically, it's actually marked the beginning of every durable advance since 1965. But what makes that important is that there have been no false positives in the historical record. So, you know, the MBI really is the only breadth thrust indicator that has never failed or shown us a false positive. And so far, when we look at the MBI, it has yet to even match the strength that it achieved off the 2022 lows. Meanwhile, in the lower frame here, we can look at the percentage of S&P 500 stocks that are now trading above their 50-day moving average. And as we can see, this number here is approaching an extreme, this extreme of 90%, which is a very extreme overbought level. And when unattended by a breadth thrust from the MBI, like we saw perhaps here back in 2020, we got the MBI to confirm this huge breadth thrust. Prior to that, 2019, big MBI breadth thrust. And again, we saw this overbought condition. That all marked a new durable advance, but we have yet to see the MBI confirm this big move up. And so what that tells us is that when we have these extreme overbought conditions, they tend to suggest that the market is at the precipice of a trend reversal when they're unattended by the MBI. And so if in fact we don't see any sort of follow through in the next day or so, I think with the MBI, and I doubt that we will, just looking at the current reading, I think it's a fair bet at this point that we are very long in the tooth with this advance, and probably near at least at the very minimum, a corrective reversal, if not something more significant. Chart number 5. The market to us appears to be in structural decline. And why do we say that? Well, we're not even looking at the S&P 500 here. We're looking at a different sort of measure. We're looking at a broader measure of the stock market. This is the Value Line Composite Index. We're looking at the geometric weighted version. The Value Line Composite includes roughly 1,700 stocks, a few less than that, but it represents about 90% of the revenue generated by all publicly traded companies in the United States. This index has been around since 1960. It's one of the oldest and certainly the broadest indexes that we have to look back at and characterize the stock market's behavior. And what we note from the 2020 lows, the COVID crash lows, which we're calling cycle wave 4, we're seeing a 5-wave advance from there. We've got at primary degree of trend 1, 2, 3, 4, and 5 to complete a 5-wave advance. Now this is heavily subdivided. We see intermediate degree of trend, we see minor wave degree of trend, and we see minute wave degree of trend, all tracing out 5 waves to the upside in that third wave, which is very typical to see those subdivisions and extension in the third wave. We have a very truncated 5th wave here, but from that 5th wave high, which actually dates back to November 8th of 2021, the orthodox top of the stock market, we see a 5-wave decline. And we can count that 5-wave decline at intermediate degree of trend. We've got intermediate wave 1, 2, 3, 4, 5. 5 waves down is a directional change of trend. We also see the subdivisions at minor degree. We have 1, 2, 3, 4, 5 wave. These are impulse patterns, okay? And an impulse wave is a directional change in the market. We believe that those 5 waves down probably represent wave A of an ABC corrective waveform. Now, what followed wave A was a clear 3-wave zigzag pattern. Again, at intermediate degree, we can see A, B, C to complete primary wave B, okay? And primary wave B was followed by 5 waves down, which we count as intermediate wave 1, and then 3-wave advance, which again is corrective, failed to make a new high, which we count as intermediate wave 2. And then we saw that followed up by another 5-wave decline that took out the intermediate wave 1 low to complete minor wave 1 down. And so far, the counter trend advance may or may not be complete, but we see 3 discernible waves. We see an A, a B, and then a 5-wave impulse to complete minor wave 2 of what will ultimately be intermediate wave 3 down, and probably followed by a complete impulse wave to complete primary wave C down. And that primary wave C will end what we believe will probably be cycle wave A of a larger degree ABC pattern. So we don't know for certain how this is going to play out or when it's going to play out. But we do see that from this general sort of form that we are nowhere near making a new high. And so we are nowhere near an uptrend here. In fact, the past 3 highs are all lower highs, right? We've got primary wave B, which occurred in February, okay, of this year. Then we have the July high, which we're counting as intermediate wave 2, and then a lower high again, which we're counting as minor wave 2. The succession of lower highs is by definition a downtrend, right? And so the thing that's interesting here is for the 3rd time this year, we're hearing how the market is broadening out, but each new broadening has been weaker than the last, okay? We've heard this story before, and it doesn't end well. We'd also point out that the 200-day moving average here in red is actually crossed below the 200-week moving average in green. That's not a good sign. We'd point out that unless this index can see a sharp and immediate acceleration to the upside, this broadening, like the others, is likely to fail. And indeed, our Elliott wave count, which is our preferred way of looking at the market, calls for a fairly significant decline in the weeks and months immediately ahead. So that kind of gives you a general perspective of what we're thinking about with respect to the market. But we want to add a bonus chart today. And this bonus chart takes a look at legendary market forecaster W.D. Gann's cycle approach to kind of forecasting the future, if you will. This is a table that Gann put together back in 1909 originally, and it has been extended and adjusted by our friends at Time Price Research, who have done some extensive work on Gann's cycle analysis. And their conclusion is that the cycle continues to point to a fairly harrowing experience going forward. We could take a look here, and this is kind of, again, without digging too deep into the weeds, because we just don't have the time in this presentation. We want to take a look at what Gann's forecast looked like. And in 2022, Gann forecasted a very high stock prices, most prosperous year, most money in circulation, most speculation. We saw a high in 2022. In 2023, again, the exact same forecast, very high stock prices, most prosperous year, most money in circulation, most speculation. And I think that definitely sums up 2023. But what is Gann looking for in 2024? Well, 2024, he sees a major panic, a crash, 4 years of falling stock prices, businesses stagnated, bread lines, soup kitchens, despair, unemployment. He sees that carrying through to 2025 and 2026 as well. In 2027, his forecast says extreme low for stock prices, strikes, repression, despair, but the beginning of a new business cycle, an 18.6-year cycle that he has worked with. He sees 4 years of rising stock prices beginning at that time and improving business conditions. He says markets markets are bare of goods and young men are becoming prominent. So those are his predictions. The extension looks at K as being the same as A. So there's been some adjustments here, but at the end of the day, if Gann's cycle forecast, as he laid it out in 1909 and was able to forecast the 1987 crash, the tech wreck, the 2008 financial crisis, about basically 100 years in advance, we think it's worth giving him some consideration about what's forthcoming, particularly as we consider a number of events that are likely to occur in 2024. We've got a major presidential election between a Republican nominee who is very controversial and a Democrat incumbent who is also very controversial to some as well. And so this could be kind of an epic political year that may actually fall on market conditions in ways that we can't possibly predict. We're also thinking that 2024 has a high probability of seeing a downturn in economic conditions. And in fact, we're actually forecasting a recession. We have 5 recession models. All of them point to recession in 2024. We said that in 2023 as well, and we were wrong. So we could be wrong again, and we're just being fair about that. We think that this cycle has extended a little further from an economic perspective, but not outside of the range of historic precedent. It's just at the long end of that range. And so, our anticipated recession, I think, was pulled off the table when the Fed jumped in and created a backstop for the banking system. And, kudos to Jay Powell and the Fed. They saved the economy once again. The question is, can they continue to do it? And we think that, ultimately, the U.S. economy has experienced 10 recessions since 1957. We think we're set up for an 11th. And we think that conditions are prime for this. And we think valuations hardly support a significant extended advance in equities. And so we are very, very cautious on equities going into 2024 and the economy. And we're going to detail all of this extensively in our January 6th publication, which will highlight our 2024 market outlook. So with that, I hope you will sign up to take a look at the newsletter when it comes out. If you want to reach out and inquire how to access that, you can certainly send us an email. You can do that via our website, www.jwhinvestment.com. You can follow us on Twitter @alpha_insights, or you can just go right to the newsletter on Substack at hugeinsights.substack.com. With that, I wish you good luck trading, and thanks very much for watching.